The Hedgeless Horseman here. It's May 11th, 2022. Uh, I thought I'd just do a video where I discuss how I look at the potential of a market crash and how it relates to miners. Bob Moriarty yesterday, actually, did a article. The stock market crash continues and takes gold stocks down too. And he goes on to say, I mean, this is basically what he expects. I think he expects it to be worse than 2008-9, given that everything is a bubble now. It's just not. It's not only housing bubble, let's say, which was the primary driver in 2008. And if we're here right now, I mean, then we should expect a waterfall flush out coming, basically. And like we've seen both yesterday and on Monday, miners got hit very hard for the simple reason that people were panicking because the market sold off hard. Gold was only down like 1.3% on Monday. Miners sold off hard, and yesterday I saw some juniors, high quality. I mean, we're talking top tier exploration stores down, 15, 20%, and that's after already crashing on Monday. So many of the best stocks in the junior sector are down like 30% or so in a week, or even more perhaps. Obviously, nothing to do with the value of the business because gold isn't really down that much. Gold is at 1850 or something like that. So it's like um, uh, it's all smoke and mirrors in terms of price. I mean, Mr. Market right now, especially in the junior sector, it has no resemblance of a pricing mechanism or a efficient pricing mechanism. This is just sellers overwhelming buyers and has nothing to do typically with the value of the underlying companies or the gold that they may or may not have on the books, etc. So it's a pure voting machine right now, like Buffett would say. People are just scared and sell. They don't care about valuations. They don't sell because it's overvalued. They sell because they're fearful, and probably some sold after reading this article. And Bob outlines two options. You have two choices, as I see things: sit on your hands and ignore share prices, or alternatively get cashed up and sit on your hands until 100 resource stocks are selling for less than the cash they have on hand, and no one wants to own resource stocks or gold ever again. I mean, the funny thing is we're not too far away from that. I've been looking more and more closely on the micro cappers, the very end of the risk curve, and I see some who are trading close to the cash levels already, which is kind of interesting because we're not, if this is correct, we're not even, the real pain hasn't even started, and some juniors are already at bear market bottom levels like 2015, 2016. What's interesting that way back then, the gold business as a whole was pure crap. I mean, it was worthless at face value at the time. Gold was at around $1,100 instead of 1850, which we have now. Producers were losing cash and were over levered, unlike now when they're close to record cash and record low or close to record low debt levels, and juniors are typically cashed up. So I mean, that just goes to show that it's like I've been saying, I don't think the market is smart at all, especially at the extremes. I mean, this is really ridiculous. I mean, juniors are already, in my opinion, better buys than in the 2015-2016 bottom. And that was after like a 4-year correction. And I think some juniors out there, or many juniors even, especially again when you include or account for the price of the value of the gold business and price of gold, they're way better buys now than the 2015-16 bottom. Although in absolute terms, yes, some miners were actually even cheaper back then. But again, they were in a much worse worse shape. And even if they had ounces in the ground, there's no way they were economic. Now even, pretty poor deposits are economic at surface because gold price is so high. But there's a few caveats to this. I mean, let's think about game theory for a while. If Bob is correct, we should expect a waterfall selling continuing basically, and the market's crashing, and that might of course take down miners like we saw last 2 days where they got obliterated. But there is a possibility that it will not happen, and in that case, if you're selling now, not when they're really undervalued, because you fear that people will continue to panic and just throw away their shares cheaper and cheaper and cheaper. I mean, if you're wrong, you're in that case giving away, in my opinion, unusually large future returns because they're so extremely cheap already. So basically, like not picking up a $100 bill because you hope there's going to be a $200 bill down the road. So that's a gamble. I mean, you're gambling. If you're right, or if you're lucky, let's say, yes, you could get, assuming that you are strong enough to buy, if they go lower, you could get an even better future returns. But if you're wrong, you'll get worse returns going forward. So it is a gamble. It's a bit greedy, really, because again, you're just banking on, let's say greater fool theory, that you're walking away from an obvious opportunity because you think that some will panic or be just dumb, let's say, and bring an even better opportunity. And at the same time, there might be some sort of collapse, but who knows how quick it will be over. What will the political response be? What will the central bank response be? I don't think we're in the same situation as 2008, 2009, because back then there were banks and a housing market that were in a bubble, and the nation states were able to bail them out, and central banks. But now the central banks themselves are in a bubble. We have ramping inflation. The governments are over levered. I mean, the US deficit is huge. So I think there's a bunch of stuff that, I mean, this was obviously not the end of the current monetary system or end of nation states, etc. I do think that the next real crash, in whatever shape and form it takes, will rewrite a lot of things. And given that, I think physical gold and silver are the absolute no-brainer, top tier things to own. I mean, those are my hedges to my mining portfolio, basically. Even though my mining portfolio is centered on gold and silver, but simply because we don't know what could happen with nationalization, other jurisdictional risk, I don't know, supply lines, costs, shutdowns, etc. So I do think, I mean, that's a completely different category. I mean, I invest in mining stocks to create wealth. Gold and silver, physical gold and silver, is to preserve wealth. Those are two completely different things. So I really think, and I should actually buy more physical gold and silver, because I think that's the premier assets to hold. However this goes, because this is obviously paper gold, for example. I mean, we don't know if during a crash, maybe the paper market goes belly up. Maybe that system crashes, and as we go down into a crash, let's say the paper market breaks and there's a shortage of physical gold, and in that case, maybe people will turn to mining stocks because that's the only way to get exposure to physical gold. So in that case, again, I don't even know how a crash will actually look like. So that's also a gamble. And if something happens, if there's a market holiday, etc., and maybe gold opens up 30%, or there's a force majeure, whatever, and it's like, gold miners opens up 100% higher, something like that. So I'm not at all keen on the thought to give away the opportunities right now, at least completely. But that's not what Bob's saying either. But I'm just airing my thoughts that the only thing I know is that they're cheap now, the mining stocks, and those are my really only criteria. Uh, Buy when it's cheap, sell when it's not cheap. Uh, so it's always a gamble, in my opinion, a bit of a greedy gamble, to let go of an obvious opportunity in hopes of getting an even better opportunity. With that said, I don't think it's necessarily a bad idea to have some. I mean, I'm always all in, which is not perhaps for everyone. But I can see. I mean, if you have, I don't know, 5% cash, 10% cash, even. I mean, even if gold miners crash 50% from these levels, and he's right on a lot of juniors, hundreds of juniors going down trading below cash levels. I mean, you're gonna probably have 10 baggers in anything you buy. So even though you have a very small hoard of dry powder, let's say, that's gonna obviously supercharge your returns. And since they're starting off cheap, they'll, like 2008. No, like the flash crash in 2020, they went down quickly, rebounded very quickly. So within 55 days, if you were on, I don't know, a vacation or out in the woods, if you got back, if you stopped looking at the market here and got back here, you would already be neutral. And then there were policy responses, etc., and it just went higher from there. And this is, of course, I mean, price is one thing, risk is something else, because gold didn't budge much. So when the liquidity event was finished, people scared shitless, margin call, stop losses, etc. And then when that settled down, people realized, hey, I mean, these are incredibly cheap right now, because gold, the value of the gold business is actually still up here and heading higher. So that rebounded very quickly. So the obvious, if you just hodled up until here, this was just a blip. But if you sold any time during this and didn't get in, you actually would have lost, or your returns would have been worse than for a dead investor who just hodled this entire thing. And of course, if you sell here or sell here or whatever, it's like you have to be right on timing, because the next day maybe it shoots up. So if you sold here but had to rebuy here or whatever, then you actually that was returned negative for your returns. So it's very tricky to time bottoms, as always. And you're probably the worse, the more momentum it has on the downside, the more inclined you're probably going to be to sell, because I mean, here just gapped down, ended at red, low of the day. Next day, okay, not low of the day, but close. Maybe you sold here because you thought, wait, it's gonna go way lower. You're banking on it going to, who knows, like 12 or something. So you sell here, waiting for this, but within 2 days it's already up to 33. That's a 50% move in 2 days. That is extremely costly over the long term, simply because you were too greedy down here and thought it would just keep on falling. That's what I don't like, because you're not getting those returns back. I mean, that opportunity was shut. The opportunity became better and better and better, but you were greedy enough that as opportunity was getting better and better, you felt that, okay, this will, the opportunity will just keep on increasing, and then it stopped, and then you had to pay up 50%. That would be a gut punch if I ever saw it. Uh, yeah, I'm not a fan of that because in that case, I mean, if you bought the bottom, yes, you'll do even better. But if you time the selling and buying it during a V-shaped flash crash liquidity event like this, you could actually destroy your future returns, and you wouldn't be better off than someone just hodling this. And also, one thing I would like to note, and you'll see this all the time in markets, and you specifically see it right now. Uh, at sentiment bottoms, when opportunities are plentiful and everything is cheap, and it's very, very, very hard to make a mistake, which is overpaying for something that should go down and stay down. Uh, People still, or not still, they more and more play not to lose instead playing to win. Look at strategic metals, for example. This is one of the sentiment proxies I used. In the April presentation, it says cash plus equities equals 39 million. Equities probably have gone down a bit now, though. But so has the market cap, and they have like 11 royalties, 100 projects, or something like that. Not that they have like 100 high quality projects, but it obviously should be worth something because this is not a bad team. So if we assume that it has not fallen, let's say, too much, I would expect that it's still trading for zero value put on the equities and royalties. So if I'm assuming now, don't take this to the bank, but I think that the market cap is equal to their cash and equity positions. That's obviously extremely cheap because you get 11 royalties, which have some value, and 100 projects, which have some value, for absolutely free. No risk, because you're not paying anything for it. But uh, still, when we're this low, and like you see it for strategic metals, over the last, over 10 years, it's not many times the stock has ever traded lower than this. And the valuations overall in some of the juniors are absolutely ridiculous. So they're akin to, you know, this level in terms of cheapness. That they are they very seldom stay this cheap, or even, less they get even cheaper. But people right now, and this always happens during bottoms, people sell or don't want to buy because they fear this move. They fear this move. In my opinion, when everything is cheap and you can't make a mistake, and there's like, future multi-baggers to get to the next sentiment high, I think you should focus more on this move. Because this going down more, by definition, should be temporary, limited in scope and time. But sure, it could go down to a bottom like this. Let's say it could be cut down by 50%. That still doesn't mean, that just makes it more undervalued. So if it would crash to this level, it's not going to stay there unless the world ends. So in that case, that would mean that it goes like this during liquidity event, flash crash, stop losses, etc. And then it's going to rebound like so. So that's not risk. That's just pain, let's say price pain, limited in time and scope. But again, this is obviously, the lower price goes, the more upside, future upside materializes all of a sudden. Because like I've shown many times, that the future return curve just steepens in absolute levels primarily, and regardless of when the next sentiment high is, it gets closer in time. So again, most people right now out there are scared shitless and sell and don't want to buy because they fear this. They fear a temporary flash crash. So the fear of this overrides uh, the future prospect of this. And that's why obviously most people lose money or can't beat the market. They do absolutely the most irrational thing they can do, which is why people sell lows. Because when the future returns are the highest, they are more inclined to sell than buy. Typically, they buy somewhere up here and then sell down here because they fear that this will come. So if they're sitting at a 50% loss already, they cannot stand the fact that, or uh, they can't even entertain the idea of seeing even more red. And no matter if you tell them that, hey, this is already incredibly cheap and it will not stay down here, it will even, for an even less amount of time, will stay below this level. And we're gonna go higher. Yeah, so basically this is how I see it. I mean, this is Bear Creek Mining, trading sardine. It's done a lot of changes, but this is just to highlight that the future returns just gets jacked up the lower this goes. So in one way, one is greedy if one is not, let's say, content with 300% expected future returns, let's say in 3 years, because they are banking on the unicorn 500% return. And that's the thing. It's like if your average junior is going to return 300% on average in the next 3 years from these levels, I think some will go way higher than that. Some will go lower than that, obviously. It's very greedy. I mean, if you do it out of greed, that's it's still a bit better or a lot better than doing it out of fear. Because if you do sell out of fear, you're not gonna buy if it goes lower. But if you are actually greedy, at least you have the plan of or you're prepared to buy if it goes lower. But the danger again is that it maybe won't go lower. So if you buy back here, you just cut a 300% return to a 200% return. So the bird in the hand, which was 300, you let out in the woods. And the bird you got back was half a bird. Well, technically two-thirds of a bird, but you know what I'm saying. So again, it's super greedy. If you do it out of fear, that's just stupid by definition because you won't buy if it goes lower in that case. If you do it out of greed, it's a gamble, and you might not be right because I don't know that a crash is gonna come, and if it's gonna come, I don't know that miners will go down. Let's say 30, 40, 50%. Maybe they go down 30% and then something happens, market holiday or something snaps, the paper gold market breaks, and the next day they're up 50 to 100%. So there's a lot of ifs. I mean, they could literally just something could happen tomorrow that has them up 50 to 100%. And maybe you can, when you sold here, you can't buy back here even. You can buy back here, let's say. So you cut your future returns. Well, in that case, I think all hell is going to break loose. But still, I mean, you're still giving away a lot of returns compared to this level. So that's a gamble. That's for everyone to decide. But it's like, don't make no mistake. That's like, this is not a time when you should be playing defense. Except for the fact that the world is going to crap and you would want physical gold and silver. So that kind of defense, yes, but in terms of the money you put at risk to create value, this is the time to play offense. And how I have gone about things during corrections, this is my fourth large correction in juniors. I'm actually down in the last month. I think I'm down more on paper than my entire portfolio was worth 2 years ago. So you're not alone feeling pain right now. But I've seen it before. I'm very accustomed to it, and I have a plan. So I know that that comes with the job pretty much. If you're always long, uh, you're gonna sit through every correction and you're gonna sit through every rally and back again, and then the next rally up, etc. So I'm not that bothered with it. Sure, it's not too fun, but I know that, I mean, my expected future returns for my portfolio are going up as price goes down. So I know I'm gonna, you know, get it back and then some. And what I've been talking about in a few videos, I think, is my propensity to do portfolio shuffling, let's say. So, for example, if we have a cascading fire sale in miners, large miners, mid tiers, small producers, developers, juniors, etc. Given that some, I just added Tectonic and Cartier Iron, funny things like Cartier Iron, for example, they have around $18 million in Eloro shares. They missed on one of their own projects that they drilled. I think it was a news release yesterday. I haven't even read through the news release. That was down 38% for a while. So it's like the worst day to release, obviously, during panic selling, and you know, come up with bad news. Uh, that went down to something around 7 million, I think. So the whole company was worth less than the company's equity position in Elor Resources. So you got all the cash the company has, all the projects, including 50% of a very large iron ore project, and their gold project, etc., for free, more than free. You got paid to get them. So I mean, an example of just how bad the market is at pricing anything right now. But in any case, my point is that some will all obviously go down less than others. So let's say I have some companies that go down 30% in a crash, and some that are already down to ridiculous levels. And they go down, even if they go down 30%, or let's say they go down 40 or 50%, I mean, and they actually trade under cash. Even if my entire portfolio would be down 50%, if I could reshuffle into names that were so absurdly cheap that a 5-bagger would be easy, like 400%, or even more, because obviously, if I see some stuff out there that I think is so cheap that when we get to the next sentiment high, I think they'll go up 400%. But at a sentiment high in a raging gold bull, when the monetary system is dying, I think you could multiply that perhaps. So imagine, so that's, I'm prepared to see my portfolio, even though it's down a lot, my total portfolio over the last month. I could see it be down 40% more, maybe even more actually, from these levels after this, you know, the slaughter we've seen. I can see it be down 40-50% more or so. But if that happens, there will be stuff there out there that is so ridiculously cheap that I think 5 and 10 baggers will be a piece of cake. So I think that if that happens, it's gonna feel shit for a while. That's probably gonna affect even me. Uh, but I think I'm gonna be even better off in the aftermath than if it didn't happen. Because again, since I'm 100% long in my portfolio, and I don't know if I'm actually capable of even raising cash, knowing that there might be a crash. Anyway, if I sell something that's down 30% to buy something that's down 70%, that's value arbitrage. I just gained 40% of future extra returns. So there's always something to do. So I have, again, some stuff that I expect not to go down as much, and some might get absolutely crushed. But if I can just reshuffle, that's why my tradable portfolio has such good returns, because at every bottom there's gonna be some. I mean, all juniors are typically very cheap during bottoms, but for whatever reason, some get absurdly cheap. Let's say there's someone who gets a margin call, he holds stock X, that gets sold. He's forced to sell, but he wasn't forced to sell stock Y, which I hold. So that might be down, a good percentage. But one that someone's forced to sell is down even more, and I can buy those shares from him. Yeah, so that's how I think about that. I'm not sure if I'm gonna raise cash again, because I feel like I'm always a bit too greedy when I not take take opportunities when they come, because I hope there's going to be an even better opportunity. But at the same time, if better opportunities come, I think I can reshuffle some of the portfolio to buy even more. And regardless, I think any dry powder deployed at that time is going to have again like 5 to 10 bagger potential anyway. So it's like, I mean, you don't need that much if you put in $2,000 with 10 bagger. I mean, that's $20,000. So that's gonna supercharge your returns. Anyway, this is a very important thing. I think this is what I see, probably what most people don't get, and one of the reasons why most people don't get it or doesn't see it this way is because most people are traders, uh, or a lot of they're traders in practice, and typically even the ones who say they are investors are not really investors. They're traders, and they say they are investors when things go up, and when they go down, they're not investors anymore. Then they're momentum traders and sell. And I talk about this, price value gap. There's a big difference between something that has gone up a lot, like let's say, the ARK fund or whatever it's called, Cathy Wood. That probably overshot intrinsic value by a mile at the top here. So that could easily go down 50%. I think it's down way more than 50%. Yeah, way more. Uh, but that can go down 50% and still be overvalued. That it goes down 50% and has no business going up to this level again or higher. At least not in a in a within the next 5 years. But on the other hand, for mining stocks, especially junior stocks, they're already way under their intrinsic value in many cases, because they have been going like this, even though a lot of juniors have their value has been going like this because they've had exploration success. I mean, like someone mentioned on Twitter, Timberline is down that it's retraced the whole pop it got from their monster holes, and the realization that RC drilling underestimated the grade. That's already been priced away by a panic selling Mr. Market. So in that case, you're actually buying the success without taking the risk, because you're paying after the fact. You can pay it. You can buy it for less than it was worth before you even knew of the good news. So that's why I keep saying that this market isn't really hard, especially now, because you can steal so much value and success that someone took risk in order to get, but now you can after the fact buy it without taking the risk. So it's an absurd opportunity across the board in the junior sector. So let's say their share prices, juniors have gone like this, their value has increased. I'm talking about the good juniors and the one with success. And let's say they go down 50%. Most people look at these scenarios the same. They think both investors are have equal problems. They're down 50% in uh, a short time frame, let's say. I would say they are night and day. This is temporary price pain. This is probably permanent price pain because this has no business going back there. This is gonna one day coincide with the intrinsic value trend. When the voting machine, which voted it way higher, is going to vote it back to the weighing machine and probably undercut it like we've seen. I don't know if this is expensive or not actually, but maybe it's cheap down here. So maybe it went from way overshooting to way undercutting. Don't know. Don't care. Because I know the miners are like ridiculously priced. I mean, this or here I still think there's a bunch of risk here. But in the juniors, they've just gotten cheaper and cheaper and cheaper, and now we've had some cascade selling last 2 days, and maybe they go down even more. That's not really a problem, because eventually the panic selling is going to stop, the stop losses are going to stop being triggered, the margin calls are going to stop, and at that point in time, I think gold will also be higher, etc. So I think that there will be a slingshot mood that you've never seen before. So the only way to mess this up is to sell, because it's gonna go like this. Whereas here you can actually be down 50% and it might be good to sell because it's still overvalued. I mean, and that's, I mean, in terms of reshuffling, let's say you saw a 50% decline here, but you were aware of a sector that declined 50% as well, but the future expected returns was this gap. So obviously you could probably make back this just from going to buying something cheap and not compounding the mistake you did by going into the next hot sector that's way overvalued and should go down 50%. So again, price, in my opinion, is not risk. It's risk if you have leverage. It's risk if you have stop losses. It's risk in many. If you get a margin call again with leverage, that's why I don't play leverage. I do not play leverage. I want to have staying power because obviously, like we're seeing right now, don't underestimate how stupid the market can be or how scared it can be. But these scenarios have nothing in common except for a short period of time they both went down 50%. But this went from a bad opportunity to a less bad opportunity. This went from an increasingly good opportunity to an absolutely enormous opportunity. And since investing is about the future expected returns, the future expected returns here are huge, while here they're actually negative. Yeah, those were my points. Again, I mean, do whatever feels good for you. I let's just say I don't have a crystal ball. I do not know how this is going to play out. Maybe we'll have a cascading crash, and maybe my portfolio will be down 50% in 6 months, or maybe not. Maybe down 20, maybe down 30, maybe not down. I have no idea. I don't know how this is going to play out. Like in 2008 or 9, in the wake of 2008-9, I mean, people hadn't heard about negative rates until it was a reality. They weren't even in the textbook. So I have no idea what the policymakers are going to do. I don't know how things are going to unfold. I don't know how the war in Ukraine is going to, you know, end. I don't know what China is gonna do. I don't, there's so much stuff. That's why I stick to buying cheap and selling when it's not cheap. Yeah, selling when it's not cheap or even expensive. But do what you're comfortable with. Never risk money you cannot afford to lose, and never risk money you need in a short time frame. So it's like, be prepared for volatility, but more importantly, know that it can come and will probably come when one way or another. and know what you'll do in case it happens. And know that there might be very hard to sell some stocks at some point in time. Know that there might be market holidays. And always know that physical gold and silver is like the anchor of everything. That is my hedge to my risk on portfolio, which is gold and silver miners. Uh, but yeah, these are my thoughts. Again, I'm not a financial advisor. You know, consider me biased and all that. And make up your own mind. But it's like, again, what Napoleon said, you should know what to do if the enemy comes in your front, your rear, your left flank, and right flank. So know the possible future scenarios and know what you should do in either one of them, or as many as you can. And, take from there, because that brings understanding, comfort, calmness, etc. So don't be don't be surprised. You shouldn't be surprised about anything, really. Look at the worst case scenarios. Look at the best case scenarios. Already have a game plan of what should be the best thing to do in any case, and realize that volatility uh, probably gonna ramp up both to the upside and downside, and know what you're doing. Thanks for listening. Bye.